Hello everyone, are you pursuing calm, rational investing? Welcome back to the channel. Today, we're going straight for a stock that the market has severely overvalued, Opendoor Technologies. Ticker $OPEN. If you appreciate rational analysis, please hit the like button and subscribe so you don't miss any of our deep dive investment breakdowns. Opendoor is currently trading at $8.48, and the market is wildly chasing its AI transformation narrative, with many investors touting it as the future star at the intersection of real estate and technology. However, we have obtained a top-tier investment strategy report. The author of this report is no ordinary analyst. It's AlphaPilot, a professional, quantitative AI model. AlphaPilot specializes in data-driven valuation and risk analysis, unaffected by market sentiment or swayed by narrative hype, through models analyzing historical data, cash flow projections, and discounted risk rates. It has reached a very sober conclusion. Opendoor's rational price target is only $4.29, implying a potential downside risk of over 50%. Today, based on AlphaPilot's report, we will dissect the three major traps of the Opendoor stock price and analyze why the current market price of $8.48 may be an extremely dangerous gamble. Trap 1. The harsh bottom line of DCF valuation. Let's first examine the intrinsic value. AlphaPilot utilizes the discounted cash flow (DCF) model, the gold standard for measuring a company's true worth. Under the most conservative base case scenario, Opendoor's intrinsic value is a mere $2.93 per share. In other words, the market's $8.48 pricing is 3 times the rational cash flow value. This means the money you are paying now is essentially a hefty premium for an idealized AI transformation story. AlphaPilot warns, the market is clearly underestimating the risks and overestimating future returns. There are several key reasons behind this figure. Opendoor's core business remains asset-heavy real estate purchasing and renovation, leading to high cash flow volatility. The AI algorithm is still in its early stages for optimizing property transaction efficiency, and actual returns are highly uncertain. The company is consistently loss-making, requiring external financing to maintain operations, which significantly pressures free cash flow, FCF. Trap 2. The punitive 0% WACC. The second trap is the inherently high-risk cost of the company's business. AlphaPilot calculated Opendoor's weighted average cost of capital, WACC, to be a staggering 0%. This is an extremely high discount rate, considered a punitive discount on Wall Street. What does this signify? Investors must demand a much higher rate of return than for typical stocks. The business is overly reliant on the real estate market cycle, resulting in high volatility. Persistent losses and capital consumption necessitate higher returns to offset the risk. Put simply, this 0% WACC directly discounts the $8.48 market price down to the rational value of $2.93. Even with market optimism, considering the risk has drastically diminished the investment value. Trap 3. The liquidation value warning floor. Finally, let's consider the worst-case scenario. If Opendoor's AI transformation fails and the company is forced to liquidate, how much could shareholders get back? AlphaPilot's report shows that Opendoor's largest asset is over $1.05 billion in real estate inventory. However, after deducting liabilities and liquidation costs, the per-share value is only between $0.88 and $1.09. This implies that buying in now at $8.48 is equivalent to betting the company can avoid nearly 90% of a potential downside. AlphaPilot emphasizes that this is a quantifiable market floor that investors cannot afford to ignore. Ultimately, AlphaPilot's price target of $4.29 was derived by integrating the following factors: optimistic market revenue projections, conservative discounted cash flow, plus a 25% high execution risk discount. The conclusion is crystal clear. At the current price, the risk-reward ratio is extremely poor. Don't chase the story. Wait for factual evidence. Key metrics to watch. Investors considering Opendoor need to monitor 3 critical pieces of evidence: achieving 2 consecutive quarters of positive free cash flow, FCF, inventory days outstanding, DIO, dropping below 70 days, the company providing data proving that AI has increased the gross margin per home. Until we see this hard, verifiable evidence, $4.29 stands as the deepest warning to blindly optimistic investors. Do you believe Opendoor can successfully save itself? Leave your thoughts in the comments section. Don't forget to like and subscribe to my channel. We'll see you in the next episode.